Thanks, Stephen. It's a great honour to be here, and my role is to talk about what the international outlook means for the Australian broad macro economy and to understand where some of our sensitivities are. So, seeing we've got so many experts on the international scene, I'll just breeze through my views on the international outlook so that you've got some sense of where we're coming from, and then get into what that means for Australia and where the risks and the sensitivities and the exposures lie. So I'll get straight into it, seeing we've only got 15 minutes, and that's always a challenge for an economist. So you can see here the global, this is probably the most aggregated way of looking at the global growth outlook. The world economy is expected to accelerate over the next few years. We've had a bit of a soft patch. It's no disaster whatsoever. It's been pretty good growth, really. But there's some really important points to note here about that growth outlook. One, it's happening around the world. The advanced economies are probably the main contributor to the lift in growth. That's the yellow and the orange. The US is leading the way. That economy looks pretty good in my view. Japan and Europe, so the activity numbers are pretty good. They're not going to set the world on fire at any time in the next dozen years because of demographic headwinds and so forth, but there is a lift going on in those countries. So we're getting the advanced economies picking up, and the emerging economies are looking pretty good too. Obviously China, and I'll come back to China. The rest of EM got through last year's volatility, which I won't go into, but there was some concern last year that it would have another EM crisis. We did not get that. Some countries are obviously exposed. So we're getting a synchronised lift in global growth. The big uncertainties out there is around China, and I'll come back to that. And in terms of Europe and Japan, their activity's okay, but they've got dangerously low inflation. The ECB just the other week announced some new policy measures, not because activity was looking like slumping again, but because inflation's getting low. They've got problems with that single currency. It forces prices to adjust internally, i.e. their currencies of places like Italy or Greece or Portugal can't do the job for them. And you're getting price deflation in the domestic economies of the periphery and Southern Europe, and that, of course, is pushing overall inflation low. They are dead scared of getting into the problems Japan had in the 1990s of deflation, the psychology of that, and so they're talking about, well, they're flagging the potential for QE. They're definitely pumping liquidity into the banking system. And in Japan, their inflation, after picking up, looks like it could be coming off again. They may need to up QE as well. And this is important for Australia, and I'll get back to why that is whether or not these places, which are otherwise looking pretty stable, do more quantitative easing, produce more liquidity. In the United States, they're winding back QE. We hope that remains on track. It looks like it is. The Fed continued to in its most recent meeting. That should be done by the end of the year, and even starting to hike rates next year, which is a great sign for their economy. So the main actual risks out there in terms of the advanced economies are the inflation outlook in Japan and Europe. Here's China. It's slowing, doesn't matter. It's still producing huge quantums of activity. And in fact, we should just get used to the idea of China slowing, because it's going to slow for the rest of our working lives. And one day it'll slow a lot as its underlying economic development interacts with natural demographic forces that might be 5 to 10 years away. But growing at 7 in terms of the economic activity it generates is more than enough. They have a great challenge there between economic reform and economic momentum. And in recent months, economic reform seems to have taken a back seat to economic momentum. Premier Li Keqiang wants growth, and of course that's for things like unemployment, but most importantly, in my view, is for his own credibility with the broader Chinese community. If they do want reform, he needs to have the support of that community. So I think his growth target of around 7.5 is very important in this first year. But they will run out of capacity to grow if they don't reform. That country has reached, I believe, close to the limits of what it can do with its current economic structures. They're aware of it. So how they get this trade-off between reform and activity over the medium term is going to be one of the great uncertainties out there. But in the next year or so, I think their activity levels will look okay. And if they do look like slowing, unfortunately their financial system's not working all that well. They'll have to rely on fiscal stimulus, and for them that means infrastructure, and that means more demand for metal, which is great for Australia. But so I think the next year or two China's okay, and it will be okay for Australia. So let's go to Australia. Here's the terms of trade. We'll start with the commodity story, because it's been all-powerful in terms of the Australian macro economy. This is the terms of trade. Phase 1, the big one, the big lift there in our export prices. It was a fantastic period. We got lots of money Now it's coming off, and we're expecting it to come off further as all the supply comes into the global commodity markets. The risk is it comes off a lot more. This is quite relevant. Whoop, I went backwards there. It's quite relevant, not just because lower terms of trade will make it more challenging for the government, and it has a very direct link into commodity prices into government revenues, as we now know, but it's benefited everyone. Our calculation has every single Australian better off around $4,500 a year because of this. As it comes off, this is one of the challenges we face. It's been well documented, the income headwind from a lower terms of trade. Our forecast, the consensus for slightly lower commodity prices, slightly lower terms of trade, suggests that that top line there will move sideways while real activity picks up, bringing those two lines a bit together over the next little while. A big fall in the terms of trade could be problematic. And when I say big, I'm talking another 20, 30% down, which isn't totally unrealistic, but is a very low probability risk factor. So that's the first phase, and it's now working against us, mildly against us, I think. The second phase of the commodity boom is the supply phase, and this is now officially working against us. These are our major projects that we take data from all different sources to look at all the major projects around energy, mining, infrastructure. The things that's in the bag are the light blue and the dark blue. There's some uncertainty in the middle. There's been a lot of cancelled projects, as you all know. The reality is there's such long lead times on all of this, whether it's mining, energy or infrastructure, is the next couple of years we're going to see a significant drop in the amount of actual physical dollars spent in this space. It's a significant amount. Between 13 and 16, these numbers suggest 60 billion taken out in terms of activity, which is roughly 20 billion a year. It's more than 1 percentage point of GDP a year, but it was actually contributing quite a bit in recent years. So the turnaround's even bigger than that. So this is, again, a big headwind. It's a big uncertainty too, how this plays out. We enter phase three, and phase three is the production boom, and we're starting to see that in some sectors, such as iron ore. There's a lot of that to come, and LNG is obviously the big one a few years down the track. And the key is that phase three is going to be still GDP positive. In fact, we've just done some research that shows it'll add about a percentage point to growth to GDP each year. But it's not very labour intensive. It won't generate jobs. In fact, it's the mining side coming off that's going to be a headwind for employment. And of course, our forecast for that 1 percentage point contribution from exports is a reasonably modest outlook for prices, as described. Not the big falls, but only modest falls. But importantly, the big lifts in supply, or the big lifts in demand, I should say, out of China. So this is actually where we're going to become even more sensitive to North Asia, to China, is that we are actually going to have a huge amount of supply being the dominant force in our commodity sector rather than prices. And if there is any disruption to the North Asia story, to the China story, then that could have quite a significant effect. But even on our core view, that is that we do get the big lift in output and exports and so forth over the next few years, which is the right view, that overall commodity story is having a less and less of a positive impact. So what does it mean? It means we have to get back to business as usual, as I call it, the non-mining recovery. What are the chances of this happening? Well, I'll go through a couple of sectors. In the end, we're going to have to judge it via the labour market. We've got to create jobs. We've got an economy that has, a society that produces population growth, and we must create jobs. And obviously, the mining sector isn't going to be a producer of jobs going forward, or a net. It's going to be shedding employment. So we need that non-mining recovery to come. But just putting the mining story behind us, the sensitivities there are all around North Asia. Okay, so moving to the non-mining stories, the sensitivities, in my opinion, while the North Asia story is important, it becomes more reliant on the rest of the world. There's very strong links between business confidence in this economy and business confidence in places like America and Europe. So the outlook for better growth there is important. What is at the core of the non-mining recovery? It's construction in the major metropolitan areas. It's residential construction, and this is dwelling approvals. I'm not sure why it says by state, because it's by sector, so I apologise for that. And we've seen a fantastic lift in that. House prices started going up, the banks are there willing to lend, and now the supply is coming through. One of the important things to remember is, as we put this mining capacity in place over the last 5 years, We did not expand our production, our construction in housing, to a lesser extent non-residential, and with a population growth, we've got an undersupply of physical dwellings in this economy. It's quite substantial. There's lots of different ways to measure it. It is substantial. We're now seeing the response. And as the Reserve Bank noted last week in their minutes, that lift in approvals is going to create great construction activity for the next year or so. Problem is they're starting to roll over, particularly the lumpy stuff apartments. Now, it's early days. You can see the orange line there. It's early days. It's a volatile series, but we do need to keep an eye on that because we do need that to remain at a really reasonably elevated level for at least another year to ensure a multi-year non-mining recovery. And the nerves are getting a little bit more jangled on this, given non-residential's turned down as well. That was lifting nicely, and then there's been a bit of a slump in the last few months. Again, this is the trend numbers. The month-to-month numbers are very volatile, so we don't want to get too concerned at this stage, but we've got to watch these approvals numbers over the next 3 months or so. As I said, the lift we've already seen is going to mean construction's okay for the next year or so, but this is the forward indicator looking 2-3 years down the track. The other bit of vulnerability I get, or what was looking good is now looking a bit soft, is the consumer sentiment. This is our weekly measure we do with Roy Morgan. The consumer is very sensitive to negative economic news, particularly mass job loss announcements, and earlier in the year we saw that. And then there's been a significant negative response to the budget, both the lead-up leaks as well as the actual report. 15% drop around the budget, the 5 weeks around the budget, 3 weeks before, 2 weeks afterwards. Last 3 weeks, 4% jump. We'll get another reading tomorrow morning. It's not quite a dead cat bounce for those from the financial system, but it's not a great lift. Consumer confidence at these levels has only been lower in the last 25 years in the financial crisis and the 91 recession. So we're not at very good levels of consumer confidence. My feeling is reading this is just how sensitive the consumer is to bad news, and this is a major issue for our economy. The consumer will not be the driver of this economy over the course of the next few years. It won't do what it did after the Asia crisis in the late 90s and leverage up, build and buy houses and buy lots of product and cause economic activity to lift. However, you need an anchor point from consumer demand for businesses to invest in the non-mining economy, to invest in plant and equipment, for their confidence to be supported. So this is critical. We cannot have a consumer that's going into hibernation. Now, one feature of the consumer that's not going to change, because we've already mentioned it because of the terms of trade, is wages. Wages growth in nominal terms, are from the data I look at, are the lowest in terms of annual growth since the 1960s, 2.6% for the last few quarters. Real terms, they're now negative, and that's because we've had very expensive labour in this country, not all because of the currency, because of the domestic dynamics and the interaction between the mining boom and the unions and the industrial relations system, and we're winding that out. And some of it's quite full on with its job losses, and obviously there's some natural part of that where people are losing high-paid jobs, low and semi-skilled workers in mining. They'll go and work in construction with a lot lower, but we're also losing it in, I don't think, a very good ways, such as Qantas offshoring because labour's too expensive here. There's lack of flexibility in some parts of our labour market, but it'll adjust. Business can't afford that labour. Now, it cheapens labour up, and over the next few years, that'll be good for business and business investment, but for right now, it's not good for the consumer. No real wage growth is a concern for the consumer. And as you can see, we've had real wage growth that's negative, but it's very brief. Now, if this is sustained for a couple of years, that will not help the consumer. We have something of a buffer in the terms of the savings rate. It's very high, but to get a good outcome on this economy, and we've got a good economy forecast, but we do have that savings rate coming down. We believe the savings rate is higher than it needs to be. There's a precautionary element to this, and that the government, having displayed its willingness to get the budget back into balance and to take government finances seriously, the fact that asset markets are going up, the fact that the global economy is looking better, will all lead to a lower savings rate. But it's very hard to forecast savings rate. And if the labour market's soft or real wages are weak or confidence is soft, that may not happen. So we need to watch that very closely. It is a buffer, but whether or not the Australian consumer chooses to use it is another thing. The key in the end will be business confidence. The business confidence situation now is much more encouraging. There was not the big negative reaction to the budget that we saw from the consumers, but we are relying on businesses to invest and create jobs. And so we need to watch this closely. That'll be the link ultimately between what's going on with the consumer and employment, and the virtuous cycle we hope to get going in this non-mining recovery will be business confidence. I'm just going to touch on one last risk, bringing it back to the international story. So those risks that I've just talked about, the international role is that we need a stable global economy, particularly the United States and to a lesser extent Europe. We certainly don't need any big problems in the world economy, and that'll be the good backdrop for the non-mining economy in Australia, for businesses here to have the confidence, for asset prices, equity values, that sort of thing to be doing okay. So we watch the advanced economies for that. But this is the risk that remains. This is the Aussie dollar, and us economists love to do fair value models. It's hard to see, but the light or the middle blue line is fair value, or what economists would say are fair value using commodity prices, interest rate differentials, this sort of thing, versus the actual. We're now starting to see the Aussie dollar go up versus its fair value. We're seeing the Aussie dollar go up and iron ore prices go down. That's not a good mix for this economy. And right now, the gap is probably about half of what the gap was in 2011-12 when we were very worried about this, as you can see there. But this is how bad outcomes in the global economy eventually drag us down. And this is why whether or not Europe and Japan do more QE, whether or not the US recovers, is critical to us. Because if those economies disappoint on the downside and they continue to produce liquidity, that liquidity will find its way into our economy. It'll push the currency up, tighten monetary conditions here. It may end up generating an interest rate response from the RBA. I'm sure it's the last thing they feel like doing right now, because everything related to domestic interest rates seems to be going well around housing. But for me, that's actually the major risk. It's been a major issue for a number of years now. It's not a risk if we get a recovery, if we don't get further QE in Europe and Japan and the US moves on and actually starts raising rates. But I believe that's a critical issue for us in Australia over the next couple of years. I'll leave it at that. Thank you very much.